Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome back, ladies and gentlemen, to another episode of the Tech Guys Who Invest podcast. Adam and I are educators at heart, which is why we started the podcast, because it's our job to help you understand how to invest wisely and safely. Now, Adam and I primarily invest in real estate. However, there are other avenues that people are using to get financially free. And in this case, we're talking about an investment vehicle known as value investing, which is popularized by a pretty wealthy and famous individual. You might know him. I think his name is Warren Buffett. Anyways, you can look up that person if you don't know who he is. And we speak with Matt Zubricki from Distilled Dollar, and he educates us on what value investing is and how you can start value investing in your own life with your own portfolio. So we hope you enjoy the show. And if this is something that you're interested in, please feel free to reach out to us either at Instagram, at Tech Guys Who Invest. You can email us directly, techguyswhoinvest@gmail.com, or let us know in the comments if you like value investing, if you practice it, what you think of it, how you feel it stands up against real estate. We'd love to hear your thoughts and engage with us. So without further ado, here is the episode. Matt, thank you so much for being a guest on the Tech Guys Who Invest podcast. We're excited to bring you on the show because you're going to talk about investing, but it's not real estate investing, as Adam and I are real estate investors.
Yeah, absolutely. I love real estate. I grew up with a lot of real estate in my family. Both my parents are brokers, both my brothers are brokers, and they still do a lot of real estate. So have been exposed to a lot of that. But growing up, started learning about something else called value investing. So I know we'll talk a lot more about that. And that's like a huge thing that Warren Buffett's all about. So I'm sure we'll dive into that on this one. But yeah, thanks for having me guys on the show. Happy to be here.
Thanks a lot. Yeah, we're excited to have you on. So why don't we start with what it is? Value investing, I don't think it's something that is common knowledge among a lot of people who aren't maybe an investor or in that space. So can you tell us what that is for people who may not know?
Yeah, I would say, in the simplest terms, it's really just trying to find something that a value investor would say has an intrinsic value above the stock market price, but that might already be overcomplicating it, right? So really it's just kind of finding valuable things in the market that other people aren't seeing as valuable. So the analogy that Warren Buffett loves to use, or at least he loved to use for like a good 50 years, was kind of going around finding cigar butts that other people had discarded on the ground and kind of gross, but he was happy to pick them up, get a few free puffs that were 100% free, but that was how he started building his wealth. And it kind of came out of the turn of the century. A lot of companies were these huge industrial companies that had a lot of assets, but they weren't making a lot of money. And so if you just looked at their assets on the book value, you could sort of develop like an intrinsic value based on, if you sold everything, but they would be trading at all these crazy, different multiples and whatever. And this guy, Ben Graham, basically lost a lot of money in one of those crashes. So he was like, this is kind of a ridiculous system, and basically went to study that for his life, basically. And so that's where security analysis comes from. And that's where this whole notion of value investing comes from. So that's all the early stages of it. So but yeah, that's like kind of the brief intro is kind of, find the cigar butts as best you can.
So it's looking for clues to what makes a company great, if you will, and then kind of investing in that greatness. Is that right? Or in that value?
Well, it's not even, so if you look at just value investing, it's nothing to do with great companies. It's looking at a price disparity in the market and trying to then, take advantage of the arbitrage and that differential. So those cigar butts, they're not great, right? They're kind of gross, right? And
Yeah.
so, I mean, sure, you might find one where someone only took 2 puffs for whatever reason, or maybe you might find a full one, right? One day or something. But most of the time, you're going to find disgusting stuff. So for Buffett's case, big transformation for his investing game, and I think a lot of people kind of equate this with value investing. He got turned on by this guy, Fisher, who said it's better to buy just want to make sure I get the quote right. It's better to buy a good company at a fair price than a fair company at a good price.
Yeah, I've heard that.
And so he had to instill that belief into Warren Buffett, who was of the mentality of, I don't want to buy good companies. I want to buy the fair companies that still have that cigar butt mentality. So he was buying and selling all these different things, these securities. So that was kind of the shift to the start of basically Berkshire Hathaway, right? This conglomerate now of all these different pieces now coming together.
Yeah,
all these good companies, instead of these fair companies, he would just pick up and discard.
It is interesting. So again, back to some people who still may not quite fully understand this, you are talking about investing in companies, and I assume you're talking about stocks.
Right, absolutely. So, Warren's a big equity investor, and at the end of the day, a stock is a slice of a company.
Mm-hmm.
So, he's always trying to get, nowadays he's got so much cash that, he's got to buy pretty much the whole company with that much cash. If he buys a $1 billion company, it really doesn't move the needle anymore. But yeah, back in the day, he was buying, he like an early stock, for example, was government employees insurance company, which is Geico, right? So it was an insurance company that only insured government employees, and statistically, it actually had basically a safer rate of drivers and less rates of accidents, but the banks were treating them essentially the same. So like basically, you saw this like price disparity started like walked into the CEO's office at like the age of 24, hotshot kid, and just he's trying to understand the business at the end of the day. And that's what, again, value investing goes back to, is trying to find that intrinsic value of what's the business worth, not what's a product worth, or what does management think it's worth, but it's trying to find that overall value.
And how is this value assessed or calculated? I know you're talking about intrinsic value, but have you ever read anything, or from your knowledge, that states it's probably not as straightforward as this, but A plus B equals C type of thing you should invest?
Oh yeah, there's tons of that stuff. So security analysis is like a book like this big, and basically Ben Graham goes through dozens of companies doing this analysis. But all these companies are like old, like railroad companies, and it's pretty simple. So, nowadays you're talking a lot of, a year ago everyone was talking about Bitcoin, and nowadays it's all these tech stocks. So it's a little trickier nowadays. But yeah, I would say in terms of the formula, value investors looked for essentially a company with a stable moat around it. That's like an analogy they often use. Basically a durable competitive advantage. Probably the biggest moat example out there is Coca-Cola, right? So you can have a great cola company out there, but there's just something about the taste of Coca-Cola. It's nostalgic, and people want to keep buying it. So that's why Warren invested, billions of dollars in Coca-Cola, right? So it's kind of finding those companies with that durable competitive advantage. And this way, the reason why you look for that is it gives you a little bit more security when you forecast the earnings, right? And that's basically what it comes down to. You're looking at a company's earnings, and if you're investing $1 and you make 10 cents on that dollar, but it's growing at 10% per year, but it's been doing that for 10 years, straight, that's like the type of company that Warren would go in after. But if it's a tech company that's up and down, year over year growth, it's hard to predict that. So value investors look for that predictable value stream, and they really look at earnings in a lot of ways. And they look for those upward trends, whether it be on earnings or within a certain market. And I can go on and on, but yeah, that's kind of like the answer there.
So Matt, what kind of things do you do to analyze these? And, I'm not asking for your specific formulas or things like that. I guess I'm asking at a little bit higher level. Like, for example, with real estate, we have certain steps we'll take to analyze a property. And, we may use a spreadsheet tool that'll help us understand the rents coming in and the expenses and all of the anticipated repairs that we'll do as part of our plan. That's an example of how we might look at it. How does a value investor analyze deals or potential stocks?
Yeah, I mean, most value investors would love to be in the position of being able to influence control over a company and buy a large enough share of the stock to make the market realize, hey, there is some intrinsic value here that's not being understood by the market, essentially, right? But I would say most of the time they kind of look at it like, that's a really good question, because I'm just thinking about, like, depending on the value investor, there's a few famous ones. And I think the term kind of gets thrown around, so it's kind of hard to really pinpoint it. But if you look at someone like, just using the Warren Buffett analogy again, he doesn't have a calculator, for example. He's never used a calculator and he doesn't like Greek, letters.
Like alphas.
If the math gets that complex, then it's not a good deal. That's what he thinks. Right?
Interesting.
So he wants it to be like, paper, back of the napkin type of math.
And do you subscribe to that?
Well, I believe that if you need to know the business, right? That's really what he's getting at.
Okay.
And, it's like, when you get into like Greek formulas, I think it gets more into predictions and things like that. So a value investor like Buffett takes a big leap when he's assuming those earnings are coming in. But, it's, again, assuming the intrinsic value is there. But, going back to kind of like the formula for it, like, basically there's a lot of ratios you look at, for cash to debt, earnings to sales. There's a lot of ratios that you can plug and chug and compare them to other companies within the sector. And maybe there's one company that's trading at a multiple of earnings that's much lower than the rest. It's a very common kind of value investor play. The reason being that, if all things are equal, all companies should be trading at the same multiple earnings. But, if one's lower, maybe it's because they got some bad press. This happens all the time. And, people like Warren love to take advantage of it. And that's where that quote comes from, where when others are fearful, be greedy. And when others are greedy, be fearful. Because he loves to hear that bad news in the press. He loves to buy that on the dip, because, that doesn't change the company's intrinsic value overnight. But going back to, what would they do? I mean, looking at like something personally, what I would do, I would just go straight to the 10Ks at the end of the day. As a CPA, I would just look at the balance sheet. I mean, just really fundamentals, income statement, like, profit loss, and then, basically just understand management. That's the most direct report you're going to get. It's an annual summary. And just if you read 10 years of those, you'll understand a company better than any news article or book or digest will ever tell you, because it's just black and white numbers and it's concrete.
Okay. I love that. There is a ton of nuggets there you dropped on us. But I wanted to draw this parallel, and I want to make sure I understand it. So with real estate, Adam and I are both problem solvers, is what we like to think of ourselves. We look for opportunities where there's a problem to be solved, where we can add value. That way, there's already some risk mitigation within that. If I understand correctly, from Warren Buffett's standpoint, he's looking at a company and he'll do a tremendous amount of research on that company, maybe the industry as a whole as well, to understand, wait, why is this company so much lower than its next competitor? goes in, understands, hey, it looks like this year they got bad press and it's just on the decrease. We can come in, maybe change management. Is that the same thought process?
Yeah, I mean, sometimes he doesn't like to technically come in and change management. He actually likes to do the opposite, where he loves to buy a company and don't do anything. Let them run it just like they're running it, and he just loves to just get that dividend check, you know. Um, and that's what he means by finding a company with good management. He loves to find those family owned or those family culture kind of companies that fit into the Berkshire family. And yeah, if you ever, we did the Berkshire shareholders meeting was just earlier this month. But if you guys ever get a chance to go out to Omaha, it's like the Woodstock of capitalism, right? And you see all these brands that he's acquired over the years, and it's like something like 50, 60 companies plus huge investments into IBM, Coca-Cola, Apple now, and it's just quite remarkable what he's built up. But for most value investors, they're really looking to look for that one or two active plays. And I would say the hardest part with being a value investor is you have to basically trust that the rest of the market's going to pick up and follow what you saw earlier, which can be extremely difficult because if you study value investing long enough, it's like you start to be introduced to these topics that Ben Graham talks about, like Mr. Market and the margin of error, which were two famous principles that he brought up in his book, The Intelligent Investor. And that's Warren Buffett all the time says that's his favorite investing book, and he learned so much from it. But it gets this idea that even if you can find the value, at the end of the day, the market's kind of that manic polar, bipolar kind of up and down swing based on the emotions. So, if you can weather the storms long enough over 10, 20, 30 years, he says that, the price will level out. But that's why value investing is just really hard. It's a hard game to play.
Yeah, Kevin, I'm smelling a Tech Guys Who Invest episode being broadcast from Omaha one year.
Yeah. Let's just get Warren Buffett on the show. Why not?
Yeah, if anybody knows Warren Buffett and you'd like to connect us, please do. Matt, that was really interesting, and you definitely shared some good information there. And you mentioned a book that Warren was a fan of. I know Kevin and I are both big readers, and I think a lot of successful people are. Are there any books that you would recommend to someone who's interested in learning more about value investing?
Yeah, I would just recommend the same book that Buffett recommends. So it's called The Intelligent Investor by Ben Graham, and he wrote it, I think, back in like 1932. So it's just the same fundamental principles, but just the first few chapters, I think, will really open the eyes to a lot of people, because it talks about the difference between an active and a passive investor. And I think, maybe egotistically, or maybe it's just human nature, but I think a lot of people believe just as soon as they learn about money that, they can out compete and they can, have a higher ROI than the market, or, they can find great deals and make tons of money. But long term, it's like, I just lost my train of thought there for a second because I just thought about something else. Sorry, someone, there's a door right here. So someone just walked by saying something. But
we were talking about The Intelligent Investor, and the first few chapters are what you need to read.
Yeah, it differentiates right away between a active and passive investor. Long story short, active investor is someone who actively is going to spend time and energy every day, weekly, monthly, yearly, studying and looking at, like you said earlier, Kevin, not just the company and the market segment, but the whole economy, every equity piece that you can ever invest in. That's why Warren's such a encyclopedia knowledge of every company out there, because he always asks himself the question of, what's my opportunity cost when I invest in Apple? Is there another company that can produce a higher ROI with my $10 billion in cash? and in his head, the difference between $100 means a lot to him. So he's really thinking those questions through. So yeah. And you mentioned earlier, just kind of joking around about, does anyone know him? I mean, just without going into details, I used to work at a company that, he was on the board. So I got to see him, a couple times a year. Like ironically, like one of my favorite stories, I told Kevin this a while back, but it was like we were getting, our board was getting a tour of the floor, and I was washing the Tupperware for my lunch, trying to be all frugal, save a couple bucks, get that investment fund going. And all of a sudden I hear basically our chief marketing guy say, "And here's the kitchen." I look over and it's like Warren and all these other billionaires. And I'm like, oh my gosh. There's like, they're just like I'm just washing my Tupperware, and it's like this giant wealth disparity.
Wow.
But no, I mean, like, at the end of the day, like I said, it's like looking at the numbers, just even seeing him in person too. It's hard to do, but it's just really looking at the black and white, metrics, is trying to avoid the flowery language from news reports, trying to avoid, like tweets or whatever. It's just looking at, not even the quarterly earnings. It's really the annual progress.
Okay. So you mentioned tweets, and I'm glad that you mentioned it. So with that in mind, I remember when Elon Musk, he's active on Twitter, and there was a segment on the Joe Rogan podcast where he smoked weed and everybody was freaking out, him being the CEO of a company. If you are a value investor, how do you look at something like that, or like a PR scandal of some sort?
Yeah, I mean, so if something like that happens, with a lot of PR scandals over the years, I'm just thinking through, there was like the whale trade loss for JP Morgan, maybe back in 2012. I remember I bought in on that dip. That was a big one. The Volkswagen, like, emissions crisis, right? I mean, these are big, fundamentally changing events to the company, but typically what happens is the market overreacts. So instead of taking the company down 25%, they take it down 35%. And, it might not have been the best investment before, but again, going back to that cigar butt analogy, it becomes a lot more appealing to, hey, you know what, let me try to ride this out. It's tough again, because sometimes I'm thinking of one of my good buddies. He tried to short Amazon because, they weren't posting any earnings, right? So from a value investor standpoint, he's pretty accurate, right? He's just saying, these companies are profitable. They're, and this was at a time when they were trading at like some 100+ multiple, right? But the thing was that, everyone had enough faith in them to keep that price high enough at that 100+ multiple, because they knew 5 years from now it was going to be priced appropriately. And that's basically what happened. It never dipped. So he kept trying to short it. So even though, like, on a fundamental level, you look at the numbers, you're right, you have to still factor in the psychology of the market. And that's why value investing gets really complicated at the end of the day, because it's like, even if you find a gold mine, it gets tricky, Yeah.
So Matt, one of the things I was going to ask you about is your investing approach, and if it's very straightforward, as in you buy these things and hold them and then decide to exit. But I'm glad you mentioned the word short there, and a lot of our listeners may not know what that means. So I guess it's kind of a two-parter here. First of all, could you give a little insight for those who may not know what a short is or a put, and then do you employ those types of strategies? It sounds like you might.
I'll say, yeah, don't short anything ever. I'm anti-shorting.
Okay.
I mean,
good deal.
I'm more of a buy and hold type of guy. So, in terms of the stocks I've purchased, I still have, let's see, all the way back here. I got my first like Berkshire share, like frame,
cool.
pretty much. Like,
cool.
I just buy and hold it. And, Berkshire was really more just to get those annual passes to go to, the Woodstock, right? But
so that was a stock certificate of Matt's first Berkshire Hathaway. For those of you who aren't watching this on YouTube, we'll just let you know what he held up there. It's pretty cool looking.
Yeah. And it costs a couple extra bucks to get them like printed out and whatnot, but I did it for like memorabilia of it, Um, but um, but yeah, I mean, like I said, it's for me, going back to the number one book I would recommend between that passive and active investor. You learn that right off the bat, and basically what it tells you is that if you're an active investor, go all in. Invest, put all your eggs in one basket, and watch that basket with your eyes, like 24/7. Don't spread your eggs across 100 baskets. Like the principles of diversification don't make sense in value investing, because if you truly found the value based on the principle of opportunity cost, you would put everything you have into it. And that's why Warren, if you look at his investment curve over the years, many times, especially like in the 70s and 60s, he would be 40-50% into just one stock, which is pretty ballsy, right?
Yeah.
When you're dealing with a lot of other people's money and things like that. But that's where you have to have the courage of your convictions and really trust in your analysis. And in terms of what I believe is, one of the greatest value investors we'll ever see. He basically just looks at, like I said, the 10Ks, the annual snapshots, tries to avoid the noise of the market, tries to avoid the daily ups and downs, what the Fed might do, or how he tries to just look at, like I said, those annual snapshots, and that tells him a lot.
So with value investing, well, first of all, I want to ask, what's your exit? I know you say you buy and hold. Does that mean you're going to hold that stock, collect the dividends till you die? Is that really what the exit is?
Well, so following again with that passive and active investor. So the active investor would want to buy and hold at least 8 to 10 years usually, because that's kind of the principle of this, is that it takes a while for the market to catch up to your beliefs here, or at least it takes a while for the market to really understand that intrinsic value like you do. And sometimes, sure, it takes a lot, less time. There's plenty of, success cases out there that are much shorter, but typically it's a longer time frame. That's why you hear that quote from Warren: try to find a stock you're willing to buy, and you're also willing to just turn off the TV and turn off the the radio and not hear anything for 10 years. Something that you're comfortable owning for 10 years, and you don't have to look at it every day. You don't have to look at that ticker. So that's kind of like the approach to value investing. You want to find something you really believe in, and if something were to change your opinion to sell right away within a month, then you're in and out. You're in and out, and that's not really the principles of value investing.
So, Matt, what is the mindset of value investing?
It's a controversial one, because you're essentially saying that the efficient market hypothesis is incorrect, right?
Interesting.
And so, yeah, I mean, it's a tough mindset. It's a kind of a contrarian mindset, but I don't want to confuse the two terms of a contrarian investor and a value investor. But I mean, the mindset's really that I mean, there's plenty of market opportunities still out there. I think the efficient market hypothesis is sort of, I think that gets people into a lot of index funds, and that kind of actually goes into the passive investor that the book talks about. And that's actually, at the end of it, that's kind of what I do. At the back of in terms of my cash flows for my investments, I pretty much just use an index fund, with the rationale of I'd rather be investing in myself in terms of my time and energy, and to look at one stock versus another stock. If I boost a 10% extra return, I'm starting off with a low base, so it doesn't really make a big difference. But if I can learn a new skill set, or launch a new product, that's gonna drive up more than 10% on an investment. So in terms of looking at it, I'm more of a passive investor. But if you're going to be an active investor, then it's really for like the 1% of people. That's really what Warren's saying out there, is like, it's not for everybody. And so if you're listening to this and you're like, oh, I'm just going to start reading some 10Ks and just start reading about, it's hard because you're competing with algorithms nowadays. You're competing with these micro trading, it's hard. So you have not only other value investors who are doing the legwork, but you also have computer algorithms to compete with as well. So that look for and scan for these ratios that I talked about earlier.
Yeah, I'm glad you gave that out to our listeners and made those last few comments. That's great.
Yeah, no, for sure. Like Warren, another move. I follow a lot of investors, but I think a lot of people follow Warren, so I just go back to him. But he basically found like a price manipulation in South Korea back in 06, 07, I want to say. And it was essentially just an old school arbitrage of just the currencies weren't trading correctly due to like a pending trade bill that was going to be passed, but it just due to like some sort of red tape, it was kind of delayed. And that delay kind of like spiked all these prices kind of out of whack. And it's like that's what I mean by like Warren's looking at all these opportunities and something like that happens and he pours billions of dollars into South Korean companies. So it's like, that's the kind of value investor he is. But thinking to some other ones, it's like if you can just find one good company that especially a smaller company too, then you can actually maybe make a difference in terms of $100,000 investment might actually get you a seat on the board, things like that. But it's a big spectrum right there, a billion versus whatever. And but
I wish I had $1 billion. Just like, oh, something's happening. I'm gonna see how this plays out.
Yeah, nice.
Yeah, and it's one approach to investing, and I think there's many approaches. And I think it's hard to say if it's gonna numerically you could look at it and say it was very effective for the 20th century. But Bill Gross talked about this before his kind of downfall in the market in I guess the media market, but like he talked about these different epochs in investing, and he kind of says we're kind of transitioning now into a new epoch, and value investing no longer has the same appeal. Kind of same what I was saying before with the introduction of more algorithmic trading.
Sure.
I think it's like now, like 96% of all volume is done electronically, automatically. So it's,
wow.
It's hard to compete in that world. And even if you're an active investor, the theory is that you're going to outcompete the market due to your effort and energy and your intelligence. So it's not that you just find a lucky gem and you invest in it, you win. It's that you're working for that ROI. But when you're competing against these big companies that have massive, teams and giant, budgets for resources, it's hard to be an individual value investor nowadays.
That makes sense. So the show is called Tech Guys Who Invest. And one of the things that Adam and I wholeheartedly believe in is investment of self. And with that, we believe that once you kind of invest in yourself enough, you can, as you mentioned, add value in a bunch of variety of ways, which is why you were talking about how you're a passive investor. What have been some of the best ways that you've invested in yourself?
Yeah, no, it's a great question. And I can actually tie it back into that same book I was talking about because some big principles came from that. But if anyone gets it, their hands on it, it's called, The Intelligent Investor by Ben Graham. And really the two chapters that Warren always recommends are chapter 8 and 20 about Mr. Market and this principle of a margin of safety. But when it comes to, putting in, your own investments of your own time, those two principles play a big factor, I think, in terms of Mr. Market. So, that's the principle of the market's going to go up and down. Mr. Market's this guy who kind of, in the story, is kind of like this drunk guy who comes in. Sometimes he's just ecstatic, wants to party. Sometimes he's kind of like drunk, down on his luck, and he's just like depressed. And, that's kind of the story of what the market's like. And you never know which way it's going to go in the day. But if you look at, things that are within your control, I would say, yeah, like definitely investing within yourself, certain skill sets you can learn, certain soft skills, especially, I think would just be, are tremendous. I would say, yeah, like, some people want to learn, coding, or there's so many resources now online in terms of online courses, online, YouTube channels or sites that have quite a lot. So, that field of self-education, I think, for the few people that actually pursue it, you are going to have that competitive advantage. And that's sort of, tying back to value investing, right? So it's like, how do you build up your own competitive, durable advantage? And then the last principle there was that margin of safety. So it's like, if you're going to build a bridge for a $10,000 or 10,000 pound truck, you want to build the weight capacity just to allow for 30,000 pounds. You don't want to, build a bridge that allows for 10,001 pounds.
Right.
So same kind of principles with kind of like your own investments of time and energy. So a quick analogy I did, years ago was I started a podcast with someone who I didn't know was going to work out, but I viewed my investment of time and energy as, even if it fails, it's going to be a huge, valuable learning experience. And so, it's kind of applying that same principle there. So, if you look at value investing from a standpoint of not just your own capital and money, but really your earning potential and your future currency, right? Your capacity to earn more. And if the younger you are, the more powerful it is today to learn the right skills or to have the right mindset. So for value investing, yeah, that's really taught me a lot towards investing in myself, for sure.
Yeah, that's great.
If any, yeah.
Yeah. No, that was good. Okay. Here is a non-investing question that we like to ask our guests because we're the tech guys who invest. So, we have like a nerdy side to ourselves, and we always find it interesting to find out what some of our guests like in terms of tech. So what's your favorite piece of tech? And it could be something that you're using right now or something that you currently like, or it could be something that you is just sort of an old favorite.
I got like a weird hobby, but I one time kind of like dug into Elon Musk's whole thing about like, the future of AI and like, all these companies out there that are investing in like Google and Apple and all these like Chinese companies. So I did some research and I basically like was like, okay, how do I learn more about this? But not from like Hollywood and not from, what I mean? Like, how do I actually get to the source information? So I picked up this giant textbook.
Oh my God.
They teach it like Stanford and all this, like it's written by like the head guy at Google and all this stuff. So in terms of tech nowadays, honestly, I think, AI is like one of the biggest things. And within AI, there's so many, there's like machine learning, there's so many other components. So I think when you study AI, you can study a lot of different things. So that's kind of like a random tech hobby that I got. It's a pretty big awesome one, but yeah, it's something I look at because it also inspires me just to try to automate more, in my own life, and then just try to be more efficient. Go into my own brand here. It's like try to distill down, my time and try to be more efficient and effective.
Yeah,
that's cool.
For those of you listening on the podcast, that book was thick, like the size of a dictionary.
Yeah, I don't understand most of it, but like I'll read, a paragraph here and there, like the intro chapters, just to get like some basic rudimentary understanding, and then it just dives into physics and like, and I'm like, oh gosh,
wow.
But just know enough to be dangerous or safe when it comes to AI. So Matt, our last question for you is, where can people find you?
Yeah, go to, I blog over at distilleddollar.com, and I pretty much try to post every Friday. Entrepreneur Happy Hour. It's a great podcast. Basically just talking about I focus on, I kind of grew up in the investing, being frugal kind of blogger world, but then hitting CNBC, MSN, all these big publications back in 2017 now. That kind of got me all these requests for, hey, how do I do what you did? And how do I make money online and all that stuff? So I sort of stumbled into that market, but But yeah, now I focus mostly on membership sites. So yeah, check out Distilled Dollar. There's tons of old content for like savings and investing. Tons of stuff about Warren Buffett, Charlie Munger, all these great value investors. You know, it's funny. Yeah, we talked a lot about Warren, but funny enough, it's like his business partner I actually admire and like a lot more. But like, you know, that's the depth of it all. But yeah, I mean, yeah, check out distilledollar.com you know, right now, basically I'm just kind of throwing up like a free savings PDF that kind of talks a little bit about what you guys were talking about with like, at the end of the day, if you really want to save a lot more, you have to increase your earnings at the end of the day. And, you know, by investing in yourself, just time and energy, it's a frugal investment. You're not wasting money. And, you know, the reward is remarkable for people that actually pursue it.
Oh, that's awesome. And just real quick, Matt, what's the name of that PDF for people so they can find it?
Oh, geez. I think it's like 17 frugal strategies we use to save 50K.
Okay.
So it was kind of like a big blog post we did. We basically saved, my wife and I, we saved 50K over a year. And so I kind of detailed the 17 little things, and it's everything from, you know, ironing my shirts that saved $200 to, you know, not going to the movie theaters that saved. So I kind of add them all up over time. And yeah, that was, so that's the PDF that kind of gives some good, I think great classic, you know, timeless tips.
We'll put a link to that PDF in the show notes. Matt, once again, thanks so much for coming on, adding value to our listeners. We really enjoyed having you.
Yeah, it was awesome. And I appreciate you guys having me on, and hope to talk soon. I hope you guys can maybe even take some time to, you know, be on our my show in a little bit here.
We'd love that.
Yeah, that'd be awesome. Thanks, Matt. That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page, where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.